Hello and welcome to Outlook Money's Investment Made Easy podcast series. This episode is led by ICICI Prudential Asset Management Company Limited under the Investment Awareness Initiative of ICICI Prudential Mutual Fund. I'm Versha Jain from Outlook Money, your host for today's session. Welcome to another episode in our series where we simplify financial concepts to enhance your understanding and greater financial well-being. Brought to you in association with ICICI Prudential Asset Management Company Limited. In today's episode, we will delve into the ICICI Prudential Nifty 500 Index Fund. It's a passive one that tracks the Nifty 500 index. This benchmark index comprises 500 companies out of all listed ones based on market capitalization. Its constituents are diverse, including large cap, mid cap, and small cap companies. The index represents approximately 92% of the free float market capitalization of listed stocks. It serves as a benchmark for mutual funds, active and passive schemes, exchange traded funds, and other structured products. Today, we'll discuss ICICI Prudential Nifty 500 Index Fund, including who should invest in it, what does it offer, the suitable time to invest, and what should one consider before opting for an index fund. To explore these aspects in detail, we are joined by Mr. Amit Vashisht, lead ETF, ICICI Prudential AMC. Let's gain insight into this fund and the broader concept of index investing. Welcome, Mr. Vashisht, to this episode.
Thank you, Versha.
Let's begin the session without much ado. To start with, could you explain to our listeners what the Nifty 500 index is and its key composition?
Sure. So before we discuss about Nifty 500 index, we'll discuss a little bit about how index these days are divided into. When we call a market cap index, which is Nifty 50, Nifty 100, Nifty 500, which we're going to talk about today, then we call sector indexes like IT index, pharma index, banking index, and then we call smart beta indices also. So smart beta indices follow some factors: value, quality. So these are the three broad divisions we have seen in equity indices. So moving to Nifty 500 index, which we have launched. So it's one of the index which is a plain vanilla market cap free float index. So what do you mean by free float market cap indexes? Top 500 companies, listed companies in India will be part of it in terms of free float market cap. When we talk about free float market cap means, let's suppose a company value is 100. Out of that, 80 is majority owned by the promoters, which is not available for the secondary market. We will consider 20% as a liquid stocks. So this basically consider of top 500 companies in terms of free float. So the advantage of this 500 is this covers a large, mid and small space of the listed entity in India.
All right. So moving on to fund comparisons now, Nifty 500 and Nifty 50 are two popular indices and both are market cap based. So could you also explain on their differences and guide investors on which is more suitable for their investment goals?
So as the name suggests, Nifty 50. Nifty 50 means top 50 listed market cap companies in India in terms of free float. So majority ultra large cap companies will be part of Nifty 50. So a new investor who's coming up and investing in the stock market, this is the ideal way to start with, because Nifty 50 is the most stable large cap companies. You get a much better stable return compared to if you're moving into more diversified and a long-term portfolio. So Nifty 50 is a pure large cap. When you talk about Nifty 500, this includes the large cap universe of first 100 companies, mid cap universe of 101 to 250, and a small cap universe of 251 to 500. So if someone is looking for a flexi cap fund in a passive, then this is an ideal product available for it. It's covering large, mid, and small. Within the listed space, almost 94% of the entire listed companies comes part of Nifty 500. So it's a more diversified portfolio. Nifty 50 is a pure large cap portfolio. Will give more stable return in your portfolio. So that's a major difference between Nifty 50 and Nifty 500.
All right. Now to go into a little bit of technicalities, please also tell us how frequently is Nifty 500 index reviewed and updated?
Sure. So Nifty 500 rebalance twice a year in January and July. So why these portfolio rebalance? So in indices, we have seen that the index means the constituents. In this, the constituents is 500 companies in terms of free float market cap. So every 6 months, the index reviews Whichever company did well can be part of 500, and the company which is not doing well will move out of 500. So that's rebalancing happening every 6 months. The good companies are coming in, bad companies moving out. So in this way, the index works as an active way also to keep the active companies a part of the portfolio. That's why the rebalancing happen every 6 months.
All right. So I can understand that every 6 months the index is reviewed and rebalanced, and I think the same is happening with the particular fund, ICICI Nifty 500 index fund as well.
Yes, index just replicate what the listed Nifty 500 indices is.
All right. So also tell us, how does ICICI Prudential Nifty 500 index fund differ from other index funds in the market?
Sure. So as we started in earlier our call, we have bifurcated indices into three pockets. One is a market cap, one is a sectoral, one is a smart beta. So now for this only, we'll talk about market cap because Nifty 500 fall in market cap indexes. So when you talk about market cap ETF, we know the most popular one, Nifty 50 or a Sensex, Nifty 100. Then we call Nifty Next 50. Then we have a Nifty Mid Cap, Nifty Small Cap. So these all, if you talk about in indexes, they are focusing on a particular market cap size. Nifty 50 is focusing on the mega large cap. Nifty 100 is focusing on the large cap. Nifty Next 50 is focusing on the 51 to 100, again a large cap space. Nifty Mid Cap is focusing from 101 to 250. Nifty Small Cap is focusing on 251 to 500. So now someone wants all this into one pocket. So that's a Nifty 500. An index which contains 50, 100, small cap, mid cap. So entire baskets coming in a one space is Nifty 500. So if anyone looking to invest into an index growth story in which he wants to be large, mid, and small, this is their ideal indexes. It's also a very active index. Why I say an active index? In 2019, more than 81% of the portfolio was a large cap heavy. Now it is 70%. So if mid and small do well because of free float market cap and in turn, their weightage increase in the indexes. Reverse also happen if large cap start doing well, their weightage further increases. So it automatically keep on allocating the weightages. So currently 70% large cap, 20 mid cap, and 10 small caps. Any idle portfolio we talk about, we generally suggest keep 60 to 70% to large cap, 20 to 25% to mid cap, and 10 to 50% to small cap. So this portfolio is automatically doing it for you. So that's the beauty about Nifty 500 index.
All right. So it is a larger basket offering all the benefits of flexi funds. Now, focusing on sectoral
Yes.
dynamics, are there specific sectors or themes that dominate the Nifty 500 index? And if yes, then how does this impact the fund's returns?
So if you talk about Nifty 500 index, there are more than 50 sectors who are part of Nifty 500, which means it's covering the entire Bharat or entire India. Whatever sector exists is part of this indices. Definitely, when you create an index, there are some heavy weightages. Now, this index is based on free float market caps. So, whatever the mega large cap companies, those companies have a heavy weightages. So, the sectors which fall in those companies become a heavy weightages. So, in India, we have seen it's majorly banking sector, which is a heavy portfolio. So, that's will be part of this Nifty 500 as well, being a major contributor in terms of sector. IT is the other one. Consumer good is a third one. So these are the three bigger sectors in terms of weightages in this index as well. Although there are very small indices which are not part of large and mid, is part of this. There are more than 20 sectors which are not part of Nifty 100 and mid cap are part of this, but majority is driven by these three sectors.
All right. So financial sector, IT, and consumer, these are the top three sectors dominating this index. Now, coming to
Yes.
my next question, considering the recent performances, the Nifty 500 index has delivered a total return of around 19% over the last 5 years. So, according to you, are index funds better than active equity funds and smart beta funds, which are becoming popular now? And what kind of returns can investors expect from index funds?
Thank you, Varsha, to highlight this. So we don't think we should uh, add this stage to decide that the passive will going to outweigh active funds because we have seen active have evolved in India last 25, 30 years. But yes, in 5, 6 years now, there are huge spread in active funds also. There are a lot of funds available in the market. Now to filter out which active fund is doing well is tough for the investors. So investors prefer to give at least 20 to 30% allocation in the passive as a category. Now talks about 500. 500 gives you participation in large, mid, and small cap. So when large is doing well, you get a majority participation into it. When mid do well, again it is part of the portfolio. So investor who want to participate in the India market and doesn't understand whether to go into which sector or into which market cap, this is an ideal portfolio to start with. That's why you're seeing the return is close to 19% in last 5 years. Well, past return is no guarantee of the future, but what we feel, if you stay invested in the equity market for at least 5 to 10 years, you can expect upper side of the double-digit returns. That's what we think. If you're investing into this one in next 5 to 10 years, you can expect a return of close around 12 to 15% easily. Now talk about active. We already highlighted it can vary on the fund style also, fund philosophy also, when sector is it's investing. So it can vary. The hot topic which you highlighted is smart beta fund. We can discuss another half an hour smart beta funds because this is a space which is growing in last 4 5 years. Smart beta fund is not an active fund. So smart beta funds basically use factors to decide which all stock to the portfolio. It is again an index which got created, but basing on the factors like value factor, or you can say momentum factor, quality factor. So if particular investor want to look into value kind of stocks, so smart beta will take a value factor smart beta. So smart beta is a very big universe which is using factors to create indices. 500 is a pure market cap fund. There is no further factor added to it. So that's how this is the simplest of the product which is available in the market. And smart beta is for the investors who want to further play into those kind of a strategy. I hope I've answered. And
Yes, thanks for explaining the differences and the benefits. Now, when evaluating investment decisions, what are the most critical factors to consider when investing in index funds? And if additionally, one more question I'm adding here, that what are the expense ratios and associated cost of ICICI Prudential Nifty 500 index fund?
sure. So we'll take the first question, the factors to consider. So if you talk about any index funds, there might be multiple AMCs who are launching the same product because there is no differentiation. Because if anyone is buying Nifty 500 of ICICI or any other fund house, they are going to invest into same companies. So how you differentiate? The first is the tracking error. So what is a tracking error? Nifty 500 is an index. Now ICICI have launched a Nifty 500 index. We have to replicate it. So how closely we able to replicate is called the fund performance. The gap between the index and us is called a tracking error. So as low as a tracking error, that good the fund is. Second is an expense ratio. Expense ratio is the charged by the AMCs to manage that particular product. Market volatility is another factor, but that depends on all the funds. The fourth one is the liquidity. So when we create a portfolio, we'll see that how liquid the stocks are because we have to replicate the entire indexes. If some of the stocks are not liquid, it will impact the tracking error of that fund, and that will increase the gap of the real index and the fund. So these are the major factors to consider while investing into any indexes. Talking about expense ratio, now SEBI have defined that index maximum expense ratio can't be more than 1%. So that's the highest we can charge in the regular scheme of index. Direct would be between 25 to 35 bips. So 0.225 to 0.35 would be the expense ratio of the direct funds. The regular fund will be close to 1%. Still much cheaper than the active funds.
All right. Now you have mentioned all the factors like tracking error, expense ratio, market volatility, and liquidity. These are the major factors which needs to be considered before investing in index funds. Now come to the risks. Please tell us what risks should investor be aware of before investing in this one, particularly due to its exposure to the broad market index.
Sure. So if investor is coming into this fund, he should be aware of that this fund includes mid and small cap as well. So we have generally seen mid and small cap see more volatility compared to large cap. So that's one of the exposure they have to keep in mind when they're coming into Nifty 500 as a broader index. Second is what we again highlighted, being a broader index. There might be some illiquid stocks, but again, the beauty about this product is a free float market cap. So those company which is negligible in decimals. So that will not impact that much into that portfolio. But definitely compared to Nifty 50, Nifty 500 will not be that liquid as compared to Nifty 50. Third, we already discussed about tracking error, which we highlighted in the last question.
Okay. And in your view, who is this fund best suited for? It's new investors or long-term investors or experienced investors? And would you recommend it more for equity-focused investors or with those with a debt-oriented outlook?
See, the beauty about this product is a new investor who's coming into equity and he want to participate in Indian growth story, then this is an ideal product for him. He doesn't have to filter it out how much to put in mid, how much into small, how much into large, which sector, which category. So this product cover all the sectors as we highlighted. More than 50 sectors are there. The bigger the sector have a higher weightage in this portfolio. The large cap have a higher weightage. So it's an ideal portfolio covering large, mid, and small. So new investor definitely should invest into it. As far as talking about long-term investors and the seasoned investors, they can also part be of this particular product because this is a flexica product with the cheapest product available in the market. So if anyone looking for a flexica product, this is an ideal product to be part of the portfolio. As far as what kind of investor, definitely should be equity oriented investor should invest into it because it's 100% investing in equity. So debt investors should avoid entering into this kind of fund unless they have 20% or 10% allocation in equity, they can come into it.
All right. So this is an alternate to the flexi cap mutual funds. Thanks for clarifying this thing. And here is my last question to you. Could you provide guidance on what percentage of an investor's portfolio should ideally be allocated to index funds?
It's vary from investor to investor. Ideally, if investor is allocating, let's suppose, 100 rupees into equity, I'm removing his other asset classes. It can be debt, it can be gold, it can be real estate, whatever it is. Whatever he investing in pure equity, he should typically invest between 20 to 40% ideally in indexes category. That's what our understanding is broadly, because that will give him a more stable portfolio. He can understand how the indexes are doing compared to the other active portfolios. That's again a personal view.
All right. Thanks for explaining it to us. Thank you, Mr. Vashisht, for sharing your valuable insights with us. I'm sure that our listeners found the session both informative and engaging.
Thank you, Varsha. Thank you for inviting us, and thank you for running a series on passive, because passive is something which everyone should at least understand what's happening in this as a space. It's a very big space outside. We have seen the new investors and family offices are now moving towards smart beta and market cap indices. Thank you for running this as a series.
Thank you. It's important to note that the contents of the discussion should not be construed as an editorial recommendation from Outlook Money. And with that, we come to the end of today's episode of the Investment Made Easy podcast. Stay tuned for the next edition in the Outlook Money's podcast series. And don't forget to like, share, and subscribe. If you have any suggestions, feedback, or questions, please send them to us at letters@outlookmoney.com. Until our next edition, take care and stay well and keep following Outlook Money, your go-to personal finance magazine.